Welcome back to the deep dive. Today, we're plunging into a topic that can make anyone's stomach drop. That tax bill you just can't pay all at once. It's a common, stressful situation. But here's the surprising truth. The IRS actually provides clear pathways to manage that outstanding balance. And even better, there are smart strategies embedded within their system that can genuinely save you money on fees and penalties. We're not talking about general tax-saving strategies today, but rather how to minimize the costs associated with an outstanding tax debt.
Precisely. This deep dive is all about understanding the IRS installment agreement, specifically Form 9465. It's a critical tool for your financial well-being. It allows you to pay off your tax debt over time rather than facing immediate and often more severe collection actions. And as you mentioned, knowing the nuances can absolutely lead to real savings.
Our mission is to cut through the jargon, break down this form and the process surrounding it piece by piece, and equip you with the knowledge to navigate this, hopefully with fewer headaches and, yes, those surprising savings on associated fees and interest. So let's unpack this financial lifeline. The core problem is something many people face. You filed your taxes, or perhaps you've received a notice from the IRS and suddenly you realize you owe a significant amount. Your immediate reaction might be panic, a feeling of being overwhelmed. You might think, what now? I don't have that kind of money just sitting around. But what's crucial to understand right off the bat is that there is a structured solution. You are absolutely not alone in this, and the IRS has a formal process specifically designed for situations just like yours.
Exactly. This structured solution is what we call an installment agreement, or IA. At its heart, an installment agreement is a formal payment plan you set up directly with the Internal Revenue Service. It's designed specifically for taxpayers who genuinely cannot pick their full tax liability immediately. Think of it as a lifeline, a way to responsibly manage your debt when a lump sum payment simply isn't feasible. Form 9465 is the specific tool you use to request this monthly installment agreement. If you find yourself in that position, whether the amount you owe is from your original tax return or from a notice the IRS sent you. Now, here's a crucial initial consideration, and it's actually suggested by the IRS themselves, right, in the instructions for this form. Before you even think about requesting an installment agreement from them, they want you to consider other alternatives.
Other alternatives like what?
Things like getting a bank loan or using available credit.
Huh. Why would the IRS suggest that? Seems counterintuitive.
Because surprisingly, these alternatives may actually be less costly than an IRS installment agreement. This is a very important point when we think about minimizing the overall financial impact. You see, the IRS will continue to charge interest and penalties on your outstanding balance until it's paid in full, and those charges can add up significantly over time. So if you could secure a lower interest rate loan from a bank, or manage to pay off the debt quickly using existing credit that carries less interest than the IRS's combined interest and penalties, you could effectively save a significant amount of money. It's an important mindset for minimizing your associated costs, even if it feels, well, strange coming from the IRS.
So it's about evaluating all your options to find the cheapest path forward, not just assuming an IRS payment plan is the only way or even the best way. It's about being a savvy consumer, even when you're managing tax debt.
Precisely. And speaking of paths, it's also important to know who this Form 9465 is specifically designed for, because it's not for every tax situation. You should use this form if you're an individual owing income tax, like what you'd report on a Form 1040 or 1040 SR. It's also for individuals who are responsible for a trust fund recovery penalty. Another specific group is individuals who owe employment taxes, for example, those reported on Forms 941, 943, or 940, but only if that business is a sole proprietorship and is no longer in operation. That's a key distinction. Lastly, it was also used by individuals who owed an individual shared responsibility payment under the Affordable Care Act, though that specific payment isn't assessed anymore for months after December 31st, 2018.
Okay, so it's really tailored for a specific set of circumstances. That means there must be situations where you shouldn't use this form, right? And maybe where you can save even more money by choosing a different route.
Absolutely. There are clear scenarios where Form 9465 is not the right tool, and choosing an alternative can significantly reduce your costs. For instance, if you anticipate being able to pay the full amount you owe within 180 days, you shouldn't use this form.
180 days. Okay.
Yeah. In that situation, you're eligible for what's called a short-term payment plan. And the huge benefit here is that you can avoid the installment agreement user fee entirely.
Avoid the fee altogether. That's a direct saving right there.
A big one. We'll dive into those fees more shortly, but
Mm.
yeah, avoiding it is ideal if you can swing the payment within 6 months. Also, if you want to request a payment plan online, which almost always comes with a significantly lower user fee, you should use that online method instead of Form 9465.
The online option is cheaper. Good to know.
Much cheaper, usually. And critically, if your business is still operating and owes employment or unemployment taxes, you should not use this form. Instead, the IRS instructs you to call them directly using the phone number on your most recent notice.
Why the difference for operating businesses?
The distinction is important because employment tax issues for ongoing businesses often have different complexities. Trust fund responsibilities, things like that, that require more direct communication.
Oh.
Choosing the correct path from the beginning can save you both time and money.
So it's really about guiding you towards the right path based on your specific situation and even, as you mentioned, your ability to pay sooner. It seems like there are already built-in ways to minimize costs even before you start filling out forms.
What's truly fascinating here is that the form itself, right on its very first page, gives you clues on how to potentially save money on fees, even before you start filling it out.
Mm.
This is where being well-informed truly pays off.
Okay, I'm listening. How does the form itself help save money?
The prime alternative to filing Form 9465 is something called the Online Payment Agreement, or OPA. The IRS even highlights it as a tip directly on the form. You can access it easily at irs.gov/OPA.
irs.gov/OPA.
Got it. The eligibility for using the OPA is quite broad. If you owe $50,000 or less, and that includes amounts from prior years, you can likely use the online application. The key advantage, and a direct saving on administrative costs, is that if you establish your installment agreement using the OPA application, the user fee you pay will be lower than if you file Form 9465.
How much lower are we talking?
Significantly lower. We'll get to the exact numbers, but it's a substantial difference. This is a big incentive to go digital if you qualify, and you can even apply through OPA before you've received an official tax bill.
This next point is truly eye-opening, especially for anyone looking to minimize costs. Just by understanding the options before you even fill out a form, you could be looking at significant savings. Imagine saving over $100, not by changing your tax debt, but simply by choosing the right way to apply for a payment plan. That's real, tangible money staying in your pocket simply by picking the most efficient application method.
Absolutely. And building on that, there's also the short-term payment plan, which allows you up to 180 days to pay your full tax liability.
Right, the one where you avoid the fee completely.
Exactly. The benefit here is huge.
Yeah.
You can avoid paying the fee to set up an installment agreement entirely. If you know you can pay within that time frame, this is clearly the most cost-effective approach.
How do you set that up? You can arrange this by calling the IRS directly at 800-829-1740, or if you owe $100,000 or less, you can also use that same OPA application at irs.gov/OPA.
So the OPA works for both the regular installment agreement and the short-term one, potentially.
Yes, for setting them up, though the short-term plan specifically avoids the IA user fee.
So it's all about being well-informed and picking the right tool for your situation. Knowing these upfront choices can genuinely save you money. It shifts the mindset from just, how do I pay, to how do I pay most efficiently and cost-effectively. It's almost like the IRS is offering a discount code if you just know where to look.
That's a great analogy. It's about being strategic. Now, it's important to understand that not all installment agreements are created equal. The IRS has different categories, each with its own criteria and implications. These distinctions are primarily focused on your ability to pay and, of course, the amount you owe. Let's break down the three main types and how they relate to the level of financial scrutiny the IRS will apply.
Okay, different types. Let's hear them.
First, we have the Guarantees Installment Agreement. This is typically the most straightforward to get approved for, but it comes with strict eligibility.
Guaranteed sounds good. What are the catches?
The tax you owe must not be more than $10,000. That's the first big hurdle.
Okay, 10,000 max.
Right. In addition to that financial cap, you and your spouse, if you filed jointly, must have timely filed all income tax returns for the past 5 tax years. You also can't have entered into a guaranteed installment agreement in those same 5 years. So, kind of a one-shot deal every 5 years.
Good track record required.
Exactly. Furthermore, you must agree to pay the full amount owed within 3 years, and you have to agree to comply with all tax laws while the agreement is active. And crucially, you must genuinely be financially unable to pay the liability in full when it's due.
So it's not just for convenience.
Correct. The main benefit of this type is that it generally has fewer requirements for approval, making it simpler if you meet all the conditions.
So the guaranteed IA is like a fast pass for smaller, clear debts if you have a perfect track record. But what if you've got a larger tax bill, say $30,000, and you don't fit that perfect taxpayer mold? Does the IRS still offer a realistic path, or are you in a much tougher spot?
That brings us to the streamlined installment agreement, which is perhaps the most common type.
Streamlined. Okay.
Generally, you're eligible for a streamlined installment agreement if your assessed tax liability is $25,000 or less. This applies to individuals, businesses with only income tax, or out-of-business taxpayers.
25,000 or less.
Now, here's a key incentive from the IRS. They've expanded eligibility. If your assessed tax liability is between $25,001 and $50,000 for an individual or an out-of-business sole proprietorship,
Yeah.
you can still qualify for a streamlined agreement if, and this is important,
If what?
if you agree to pay by direct debit or payroll deduction.
Ah, there's that preference for automated payments again.
Exactly.
Yeah.
This is a significant point, is that IRS clearly prefers these methods, and it can save you from a deeper financial review. Your proposed payment amount for a streamlined agreement must pay the full assessed tax liability within 72 months, or by the collection statute expiration date, CSED, whichever is less.
72 months. That's 6 years. Okay. And what exactly is the collection statute expiration date, or CSED?
Good question. The CSED is normally 10 years from the date the tax was assessed. However, it can be suspended or extended for various reasons. For example, if you're in bankruptcy or if you submit an offer in compromise. For more detailed information on how the CSED works, the IRS points you to irs.gov/time heirs can collect tax.
Okay.
The key benefit of a streamlined installment agreement is that generally it does not require a financial statement, which is Form 433-F, or a notice of federal tax lien NFTL to be filed.
No Form 433-F. That sounds like a big deal. Less paperwork.
A huge deal. Less paperwork for you and less impact on your credit, as an NSTL can show up on credit reports. This is a major advantage for taxpayers.
So the streamlined option sounds like the most common, less intrusive path, especially if you can commit to direct debit. That makes a lot of sense from the IRS's perspective, consistent, automated payments. But what if you truly can't even manage to pay off the full amount within that 72-month time frame or before the CSED?
That's when you're looking at a partial payment installment agreement, or PPIA.
Partial payment. Okay, the name says a lot.
It does. This type of agreement is for situations where your proposed monthly payments will not pay the full balance owed before the CSED. Because this is a more significant concession from the IRS, it comes with more stringent requirements.
Makes sense. What kind of requirements?
You will be required to complete a financial statement, that Form 433-F we mentioned, and provide supporting financial information. This is a more intrusive process because the IRS needs to verify your inability to pay in full. They want to assure that the partial payment is genuinely all you can afford.
So they really dig into your finances then.
They do. Furthermore, if a PPIA is approved, your agreement is subject to future reviews to confirm if your financial situation has changed. You may be asked for new financial statements, and based on that review, your monthly payment could be reduced, increased, or remain the same.
So the PPIA really signals a deeper financial challenge, requiring more ongoing engagement with the IRS, which feels quite different from the streamlined option. It's almost like the IRS becomes your financial advisor, really digging into your budget.
That's a great way to put it. This raises an important question. Why the different tiers? It's about balancing the government's need to collect taxes with the taxpayer's genuine inability to pay. The more you owe, or the longer you need to pay, the more information the IRS requires to ensure the agreement is viable and fair. They need to ascertain that you are paying what you can reasonably afford and that the agreement serves its purpose of resolving the debt. It's a risk assessment for them.
Right. The more risk they perceive, the more info they need.
Precisely. More risk, meaning less likelihood of full payment, requires more information to protect their interests while still offering a path forward.
Right, now that we understand the different types of agreements and how they scale with your debt, the next logical step is to turn our attention to the form itself. How do we translate this understanding into actually filling out Form 9465 effectively, and where are the crucial points that determine your outcome and potential savings? Don't worry, we're not going to read it line by line like an instruction manual, but rather highlight the crucial sections where your choices make a real difference, starting with identifying yourself and the tax debt.
Exactly. We'll start with part 1, installment agreement. Request your proposal. This is where you tell the IRS who you are and what you're proposing to pay. The first few sections are pretty straightforward. At the very top, you'll state which tax forms and the specific tax years or periods your debt relates to. Easy enough. Then you'll provide your basic personal information name, social security number, current address.
Standard stuff.
Right. If you file jointly, remember to include your spouse's name and SSN in the same order as on your tax return. If your address is new, there's a simple box to check. And if you're applying for a defunct business, remember, only out-of-operation sole props you'll include its name and employer identification number, or EIN. Finally, you'll provide contact phone numbers and the best time for them to reach you. These details ensure the IRS can accurately identify you and communicate effectively. Okay, basic ID done. Then we get into the numbers calculating your amount owed. This is where you lay out the full scope of your tax liability, and there's a key opportunity for indirect savings here.
Absolutely. On line 5, you'll enter the total amount you owe from your tax returns or notices. Pretty simple. But line 6 is a crucial detail that many might overlook. This is where you enter any additional balances due that are not already reflected on line 5.
Additional balances, like from other years or adjustments. Exactly. Could be amounts from other tax periods or adjustments not yet formally reported. Ensuring you list everything here gives the IRS a complete picture and helps prevent future complications or separate collection actions down the road. Then, line 7 is simply the sum of lines 5 and 6, giving your total tax liability.
Total owed. Got it.
Now, line 8 is extremely important for minimizing your total cost. It asks for any payment you are making with this request.
Ah, the upfront payment.
Yes. Even if you can't pay the full amount you owe, you should pay as much as possible up front. Why?
Because interest and penalties keep adding up.
Precisely. Interest and penalty charges continue to accrue on your outstanding balance every single day until it's paid in full. By reducing that principal balance right away, you directly limit those ongoing charges. That can amount to significant savings over the life of your installment agreement.
How do you make that payment?
If you're filing Form 9465 with your tax return, make this payment along with your return. If you're filing Form 9465 by itself, maybe in response to a notice, attach a check or money order made payable to the U.S. Treasury. Make sure to include your name, SSN, tax year, and tax form number on the check or money order itself.
Good tip.
That line 9 is simply your total owed from line 7 minus your initial payment from line 8. This is the amount your installment agreement will actually cover.
So paying as much as you can up front is a direct, smart move to save on those compounding costs. It's a proactive step that pays off immediately. Now, how do you actually propose your monthly payment to the IRS?
That's on lines 10, 11A, and 11B, where you'll determine your monthly payment proposal. Line 10 is a quick calculation. You divide the amount on line 9 by 72.0.
Divide by 72? Why 72?
That gives you a baseline monthly payment that would clear your debt in 72 months, or 6 years, which is a common duration for many streamlined agreements. This figure serves as a benchmark for your proposed payment.
Okay, a baseline payment amount.
All right. Then, on line 11A, you enter the amount you can realistically pay each month. The IRS encourages you to make this payment as large as possible to limit interest and penalty charges.
There it is again. Pay more if you can to save overall.
Exactly. This reiterates our earlier point about minimizing costs. If you don't propose an amount, the IRS will typically calculate one for you using that 72-month benchmark from line 10. Line 11B is for if your proposed payment on 11A is less than the line 10 benchmark and you realize, wait, I actually can increase it a bit, you'd enter your revised higher payment here.
Okay, so you propose what you can pay, ideally meeting or exceeding that benchmark.
Right. And this section, around line 11, is critical because it leads into the crucial Form 433F decision tree.
The what now?
Think of it as a sliding scale of IRS scrutiny, determining whether you'll need to submit that detailed financial statement, Form 433F.
Ah, okay. The form that means more paperwork and financial disclosure.
Yeah. Exactly. Let's simplify this into 3 key scenarios. Scenario 1, deep dive required. If your proposed monthly payment on line 11A or 11B is less than that line 10 benchmark, and you genuinely cannot increase it to meet or exceed that benchmark, then you must check the box below line 11B and complete and attach Form 433F.
So low payment proposal equals full financial review.
Generally, yes. It tells the IRS your proposed payment is below their standard, and they need to see your full financial picture to justify it. Scenario 2, streamlined path to no Form 433F. If your total amount owed from line 9 is over $25,000, but not more than $50,000, A&D, your proposed payment on line 11A or 11B, is more than or equal to the amount on line 10.
So you owe a decent amount, but you're proposing to pay at least the benchmark rate.
Then you get a significant break.
Yeah.
You don't have to complete Form 433F.
Nice. But there's a catch.
Right, there is. To avoid that financial statement, you must commit to either direct debit on line 13 or payroll deduction on line 14.
Ah, the direct debit incentive again. Pay the benchmark and use automated payments, and you avoid the deep dive.
Exactly. It's a very strong incentive. Scenario 3. Full disclosure, always. If the amount on line 9 is greater than $50,000, regardless of your proposed monthly payment, you must always complete and attach Form 433F.
Over 50 grand, you automatically fill out the financial statement. No way around it.
Correct. That's a hard rule for higher debt amounts. And there's also a special case. If you defaulted on an installment agreement in the past 12 months, A&D you owe more than $25,000, but not more than $50,000. A&D your proposed payment is less than the line 10 benchmark. Then you don't fill out 433F, but you must complete Part 2 on page 2 of Form 9465.
Okay, that's incredibly practical. The biggest takeaway here seems to be that your choices on lines 11 and 13, especially around direct debit and your proposed payment, can significantly impact whether you need to disclose more financial information to the IRS. The IRS is basically saying, if you commit to consistent higher payments, especially via direct debit, we won't dig as deep into your finances. That's a huge time and privacy saving for you.
Absolutely. It streamlines the process considerably if you meet those criteria. Moving on, line 12 allows you to choose the day you want to make your payment each month. You can pick any day from the 1st to the 28th.
Oh, that's useful. Align it with payday.
Exactly. The IRS will inform you of your first payment due date once your agreement is approved. This flexibility can be very helpful for managing cash flow.
Now, lines 13A, 13B, and 13C cover your payment method, specifically direct debit, which we've mentioned is often the most cost-effective.
The IRS highly recommends direct debit. They call it the most convenient way, and note that it will ensure that they are made on time. This is a critical point because timely payments help you avoid defaulting on your agreement, which, as we'll discuss, has severe consequences.
Right, avoiding default is key.
To fill this out, you'll provide your bank's routing number on line 13A and your account number on line 13B. It sounds simple, but double-checking these is crucial. They even guide you on where to find this info on a check, emphasizing that the routing number might differ from what's printed if payable through another institution. Get it wrong, and your agreement could be delayed or even rejected, causing you to miss out on those lower fees and the benefits.
So double-check those bank numbers carefully.
Definitely. And here's another key saving point, especially for those with lower incomes. Line 13C is specifically for low-income taxpayers.
Ah, yes, the low-income benefit. How does this work on the form?
If you qualify as a low-income taxpayer and you are unable to make electronic payments via direct debit, meaning you check this box instead of providing your banking info, your user fee for the installment agreement will be reimbursed upon completion of your installment agreement.
Reimbursed upon completion, so you still pay it initially.
In this specific case, yes, you pay the reduced fee upfront, but you get it back later. It provides a crucial option for those who cannot utilize direct debit, but still qualify for financial assistance with their fees.
That's a fantastic benefit for those who qualify, ensuring that the administrative cost doesn't become another barrier to managing their debt. It's great to see that provision.
Finally, line 14 offers the option for payroll deduction. If you want your employer to deduct payments directly from your paycheck, you check this box. You must also attach a completed and signed Form 2159, the payroll deduction agreement, and your employer will need to complete their portion of that form too.
So a bit more coordination involved there.
A bit more, yes. And at the very bottom of Part 1, you'll find the signature lines, your signature and the date are required. If it's a joint return, both spouses must sign.
Both signatures always for joint returns. Important detail.
Crucial. By signing and submitting this form, you authorize the IRS to contact third parties and disclose your tax information to them to process the request and administer the agreement over its duration. You also agree to the terms if it's approved.
Okay, that's a comprehensive breakdown for Part 1, which covers the vast majority of what most people will need to fill out. Again, the big takeaway here seems to be that the choices you make around direct debit and your proposed payment amount can significantly impact whether you need to disclose more financial information, which can save you a lot of time and hassle.
Absolutely. Now let's move to Part 2. Additional information, the deeper financial dive. As the name suggests, this part is only required under very specific, higher-risk conditions. It signals to the IRS that they need a much more detailed picture of your financial situation before they can approve your installment agreement.
The deep dive part of the form itself. Okay, when is this required?
All three of these conditions must apply to you. 1, you defaulted on an installment agreement in the past 12 months. This indicates a previous issue with adherence to a payment plan.
Okay, prior default.
2, you owe more than $25,000, but not more than $50,000, as calculated on line 9 of Part 1.
That specific 25K to 50K range again.
And 3, the amount you can pay each month, entered on line 11A or 11B in Part 1, is less than the amount calculated on line 10, which, remember, is that 172nd benchmark of your debt.
So prior default, debt between 25K, 50K, and a payment proposal below the benchmark, all three.
All 3, yes. It's important to note, if you owe more than $50,000, you actually skip Part 2 altogether and must complete and attach Form 433F, the full collection information statement, instead.
Right, over $50 goes straight to the full financial form.
Exactly. Part 2 is specifically for that narrow band of debt, 25K, 50K, when there's a prior default and a low proposed payment.
So this section is really for those specific scenarios where the IRS needs to take a closer look because there are more red flags. What kind of details do they ask for here?
In Part 2, the IRS asks for a lot of granular financial and household information. For example, on lines 15 through 18, they gather household information. This includes the county of your primary residence, your marital status, and specifically if you share household expenses with your spouse. They also ask for the number of dependents you'll claim this year and the number of people in your household who are 65 or older. This paints a picture of your household size and basic financial commitments.
Okay, dependents, older household members, shared expenses.
Then, on lines 19 through 22, they delve into your income details. You'll specify how often you are paid and your net income per pay period. That's your take-home pay after deductions. And for married individuals, lines 21 and 22 are particularly important. You must complete these lines for your spouse's income if you're married and either one you live with and share household expenses with your spouse.
Even if the spouse doesn't owe the tax.
Even if only one spouse is liable for the taxes, the total household income and expenses are relevant to your ability to pay. Or 2, you live in a community property state where the non-liable spouse's income may be factored in.
Ah, community property states. That's a key factor.
It is. This applies whether you file jointly or separately. The IRS needs to understand the total household financial capacity.
That makes sense. It's not just about your income, but the entire household's ability to contribute to the financial health. They want the full picture.
Exactly. And finally, on lines 23 through 27, they request expense details. This includes things like the number of vehicles you own, how many car payments you have each month, your health insurance status, and if your premiums aren't deducted from your paycheck, how much those monthly premiums are. They also ask about any court-ordered payments you make, like child support or alimony, and their monthly amount if not deducted from your paycheck. Lastly, you'll list your monthly child or dependent care payments, specifically not including any court-ordered support.
So cars, health insurance, court orders, child care, basic living expenses.
Right. This raises an important question. Why does the IRS need this level of detail? It's all about determining your true ability to pay. They're trying to understand your full financial capacity and ensure that the proposed payment plan is realistic for your situation. They want to be sure that you're not trying to avoid paying what you legitimately owe, but rather that the plan genuinely reflects what you can afford. This ensures a higher likelihood of success for the agreement and full collection of the debt, even if it's over a longer period or in partial payments.
Okay, so part 2 is the IRS verifying your claim that you can only afford that lower payment amount, especially given a prior default. Makes sense. Beyond the tax you owe, there are other financial implications with an installment agreement, like fees and interest. But also, knowing the rules can lead to some smart savings that many people might not be aware of. Let's break down these costs and, crucially, how to minimize them.
One of the most direct costs is the installment agreement user fee. The IRS charges a fee just to set up an IA, and the amount varies significantly based on how you apply and how you propose to make your payments. These fees were updated and are effective as of July 1st, 2024.
What's truly fascinating here is the massive difference in fees. Opting for the online direct debit option over, say, the paper form with other payment methods could save you well over $100 in fees alone. That's real, tangible saving that comes from knowing your options and choosing the most efficient path. Let's hear the numbers.
Absolutely. It's stark. If you establish your agreement using the online payment application, OPA, the fee structure is much lower. If you opt for direct debit through OPA, the fee is only $22.
$22, okay.
If you choose to pay by check, money order, or credit debit card through the OPA, it's still a reduced fee of $69.
$69. Still much less than using paper.
Right. Now, if you are not using the online payment application, meaning you're filing the paper form 9465, the fees jump considerably. For direct debit via the paper form, the fee is $107.
Wow, $22 online versus $107 on paper for the same direct debit payment method.
Exactly. And if you plan to pay by check, money order, or credit debit card using the paper form, the fee is $178.
178, that's a huge difference from $69 online.
It is. If you use payroll deduction through Form 2159, your user fee will also be $178, unless you're a low-income taxpayer, which we'll get to. There's also a reduced fee of $10 if you need to reinstate or restructure an installment agreement, but only if you do it through the OPA.
The message is clear. Use the online payment agreement if you possibly can, especially with direct debit.
Absolutely. This clearly shows the IRS's preference for online and automated payments and rewards you financially for using those methods.
Those fee differences are stark. It's a clear incentive. But what about taxpayers with lower incomes? Are there any benefits for them regarding these fees?
This is where significant savings can occur for low-income taxpayers.
How do they define low income?
The definition, for this purpose, is a taxpayer with adjusted gross income, AGI, for the most recent tax year available, at or below 250% of the federal poverty guidelines. You can refer to Form 138844 instructions for details on how to determine if you qualify based on your income and household size.
Okay, 250% of the poverty line. What are the fee benefits?
If you are a low-income taxpayer, there are distinct fee waivers and reimbursements available. First, if you qualify as low income and you agree to make electronic payments through a direct debit installment agreement, DDIA, by providing your banking information on lines 13A and 13B of Form 9465.
So low income and using direct debit.
Then the IRS will waive the user fees for the installment agreement entirely.
Waive it completely, so the fee is zero.
Correct. This is, without a doubt, the best option for qualifying low-income taxpayers. Zero setup fee if you use direct debit. Now, second scenario. If you're a low-income taxpayer and you are unable to make electronic payments through a DDIA, perhaps you don't have a bank account or direct debit simply isn't feasible, which is why you would check box 13C.
Right, the box we mentioned earlier.
Then the IRS will reimburse the reduced $43 user fee you paid upon completion of your installment agreement.
So you pay $43 up front, but get it back when you finish paying off the debt.
Exactly. It ensures there's still significant relief even if direct debit isn't possible. And if the IRS doesn't automatically determine you qualify for low-income status based on their records, you can proactively request consideration using Form 13844, Application for Reduced User Fee for Installment Agreements.
Form 13844. Good to know there's a form to apply if needed.
Yes, it ensures that everyone who is eligible has a pathway to these fee reductions or waivers.
That's incredibly helpful. It shows the system has provisions to ensure these administrative costs don't disproportionately burden those with limited financial means.
Beyond the user fees, there are other costs, interest and penalties.
Ah, yes, the ones that keep adding up.
This is a crucial point that bears repeating. You will be charged interest and a late payment penalty on any tax not paid by its original due date, even if your request to pay in installments is granted.
Even with an approved agreement.
Yes, these charges will continue to accrue until the full balance is paid. So while an installment agreement gives you breathing room and prevents more severe actions, it's not a free pass on the ongoing accumulation of costs. The faster you pay down the principal, the less interest and penalties you'll ultimately incur. It's also worth noting a specific detail regarding the Shared Responsibility Payment, or SRP, under the Affordable Care Act for those older tax years.
Okay.
While interest will continue to accrue on the SRP amount owed, that specific payment is not subject to penalties or to deal. Notice of federal tax lien or levy enforcement actions. However, any federal tax refunds you are due may still be applied to the SRP amount.
Interesting nuance for the ACA payment. This highlights a critical cost-saving strategy then. Make your payments as large as possible right from the start, and maybe even pay extra when you can. The faster you pay off the principal balance, the less you'll pay in interest and penalties over the long run. It directly translates into saving money.
Exactly. Every dollar you can pay above the minimum required payment reduces the base on which interest and penalties are calculated. It accelerates your path to debt freedom and minimizes the total cost you pay to the IRS.
You've submitted your form. You've understood the potential costs and savings. Now, what's the IRS's role once they receive your request? And perhaps more importantly, what are your ongoing responsibilities and rights in this agreement? This next phase is about what happens after you click send or drop that envelope in the mail?
Right. Let's talk about the approval process. The IRS typically lets you know whether your request for an installment agreement is approved or denied within 30 days of receiving it.
30 days usually?
Usually. There's an exception, though. If your request is for tax due on a return that you filed after March 31st, it may take the IRS longer than 30 days to reply, likely due to the peak filing season volume. If your request is approved, the IRS will send you a notice detailing the specific terms of your agreement, the monthly payment amount, your due date, and it will also request the user fee we discussed earlier, if one applies to you.
Okay, so you get official notice with the terms.
Yes. Now, how the agreement works post-approval. By approving your request, the IRS essentially agrees to let you pay the tax you owe in monthly installments instead of requiring immediate full payment. In return for this flexibility, you take on significant obligations. You agree to several key things.
What are the main commitments?
First, you must make your monthly payments on time. This is paramount. Missed payments can lead to default. Second, you also agree to meet all your future tax obligations.
Future taxes too. What does that mean exactly?
It means you must ensure you have enough withholding from your job, or make sufficient estimated tax payments throughout the year so that your tax obligation for future years is paid in full when it's due. And crucially, you must timely file your future tax returns. If you don't file required tax returns on time, your installment agreement request could be denied or your existing agreement could be terminated.
So stay current on everything going forward.
Absolutely. And finally, especially if you have a partial payment installment agreement, you agree to provide updated financial information when requested by the IRS for those periodic reviews we mentioned.
That sounds like a clear set of responsibilities. It's not a one-time fix. It's an ongoing commitment to financial compliance. It's almost like a financial contract where both sides have clear expectations.
Indeed. It's a partnership, essentially, to resolve the debt. And something important to note regarding refunds.
Oh, right. Tax refunds. What happens with those?
Any federal tax refund you are due will be applied against the amount you owe, even if you have an active installment agreement.
So they take your refund to pay down the debt faster.
Yes. And importantly, you are still required to make your regular monthly payment even if a refund has significantly reduced your overall balance. Don't skip a payment just because you had a refund applied.
Good warning. Keep making those payments regardless. What happens if you don't meet those obligations? What are the consequences of non-compliance or default?
If you don't make your payments on time, or if you don't timely pay a balance due on a future tax return you file, or if you provide materially incomplete or inaccurate information, your installment agreement may be terminated.
Terminated? That sounds bad.
It is a serious consequence. Before the IRS terminates the agreement, you may be entitled to an appeal under the Collection Appeals Program, or CAP. We'll touch on that. However, if the agreement is terminated, the IRS may take more aggressive enforcement actions to collect the entire amount you owe.
Like what kind of actions?
This can include filing a Notice of Federal Tax Lien, NFTL, which can impact your credit score and ability to get loans, or issuing an IRS levy, which allows them to seize assets like bank accounts or garnish wages directly from your employer.
Ouch. Levies and liens. Definitely want to avoid that. This really underlines the importance of sticking to the plan. Using direct debit, as we discussed earlier, can be a great safeguard against accidental missed payments, making sure you stay compliant. It removes one less thing to worry about each month.
Exactly. It removes the human error element of forgetting to mail a check or make an online payment. And to reiterate a point from earlier, while Notice of Federal Tax Liens are generally not filed for guaranteed or streamlined installment agreements.
The simpler ones.
Right. They can be filed in certain situations, especially if you default on the terms of your agreement. However, remember, an NFTL will not be filed for the individual shared responsibility payment under the ACA.
Even when you're in a tough spot with the IRS facing termination or liens, you still have substantial taxpayer rights and appeals. It's not just a one-sided street where the IRS makes all the rules.
That's very true. You have several avenues for recourse. The Collection Appeals Program, CAP for instance, allows you to appeal certain collection actions.
Like before they terminate the agreement?
Yes, you can appeal before an installment agreement is terminated, or even before and after a Notice of Federal Tax Lien is filed. It gives you a chance to present your case to an independent appeals officer. There's also Collection Due Process, CDP. Under CDP, you're entitled to an appeal regarding an NFTL filing, but importantly, only for the first filing of an NFTL for the unpaid tax liabilities shown on it.
Only the first filing.
For CDP rights related to that specific NFTL, yes, CAP might still be an option later. Furthermore, if an NFTL has been filed against your property, you may be able to get it withdrawn if you qualify under certain circumstances, like if the NFTL was filed in error or if you enter into a direct debit agreement under specific conditions. The IRS website has more info on lien withdrawals at irs.gov. Businesses, small businesses, self-employed, understanding of federal tax lien.
Okay, so options exist even after a lien is filed.
Yes. And for a broader understanding of the whole process and your rights if you can't pay, the IRS provides Publication 594, the IRS collection process. It's a very useful document.
Publication 594. Good resource. And what if you feel like you're just not getting anywhere with the IRS or you need independent help? It sounds like you're not alone if you hit a wall.
That's where the Taxpayer Advocate Service, or TAS, comes in.
TAS? What's that?
This is an independent organization within the IRS that is specifically designed to help taxpayers and protect taxpayer rights. Their whole mission is to ensure that every taxpayer is treated fairly and understands their rights under the Taxpayer Bill of Rights.
Independent within the IRS, how does that work?
They have their own reporting structure and advocate on behalf of taxpayers, often challenging IRS actions or procedures when appropriate. They act as your voice within the system.
When should someone contact TAS?
You should contact TAS if your tax problem is causing you significant financial difficulty, if you've tried repeatedly and been unable to resolve your issue directly with the IRS through normal channels, or if you believe an IRS system, process, or procedure isn't working as it should and is causing you harm.
And is this service expensive?
The key takeaway here is that this service is completely free.
Free help from within the IRS system. That's amazing.
It's a vital resource. You can find your local advocate's number at taxpayeradvocate.irs.gov, contact-S, or call them toll-free at 877-777-4778.
taxpayeradvocate.irs.gov or 877-777-4778. Definitely worth keeping that info handy. It's empowering to know that even when you're in a tough spot with the IRS, facing tax debt, you still have substantial rights and independent resources like the Taxpayer Advocate Service to help you navigate it. It really empowers you, even in a seemingly disempowering situation.
After meticulously preparing your form, checking all the boxes, making those key decisions about payments and direct debit, the final crucial step is to send it to the correct address.
The mailing address. Seems simple but easy to mess up.
It can be, and getting this wrong can significantly delay your request. That means more accrued interest and penalties and prolonging your anxiety. So this seemingly small detail is incredibly important for the efficiency and cost-effectiveness of your application. The correct mailing address depends on how you're filing Form 9465.
Okay, what are the scenarios?
Scenario 1. If you are filing Form 9465 with your tax return, maybe you know you'll owe when you file you should attach Form 9465 to the front of your tax return. Then, you simply send your entire tax return package with Form 9465 attached to the address provided in your tax return booklet for filing your return.
So just mail it with your regular tax return to the usual place. Easy enough.
Right, that's the most common scenario if you're applying at the same time you file your annual return. Scenario 2. If you've already filed your tax return, or if you are filing this form in response to a notice from the IRS, you will send Form 9465 by itself.
Okay, filing it separately, where does it go then?
In this situation, you need to send it to a specific Internal Revenue Service Center address. This is where it gets a little tricky, as the addresses vary significantly based on your state of residence. And it can also depend on whether you're filing Form 1040 or 1040-SR with certain schedules attached to that return for the year in question, specifically Schedule C, Business, Schedule E, Rental Royalty, or Schedule F, Farming.
Whoa, so it depends on your state and potentially the type of income you reported on the return the debt relates to.
Exactly. It's not a one-size-fits-all mailing address, and you really need to pay attention to the instructions.
This is a classic read the fine print moment that can save you a lot of headache.
It really is. For instance, depending on your state and whether you file those specific schedules, your address could be an IRS center in Andover, Massachusetts, Kansas City, Missouri, Memphis, Tennessee, or Austin, Texas, among others. There are also specific addresses if you live in a foreign country, a U.S. territory, or have an APO-FPO address, or if you filed Forms 2555 or 4563. The key takeaway for you, the listener, is to always check the exact where to file instructions for Form 9465 for your specific circumstances to ensure you send it to the correct IRS Service Center.
Check the instructions for your specific situation.
Got it. That small step ensures your carefully crafted payment plan actually gets to the right place and starts the process without unnecessary delays. And to tie it all back to the broader goal of minimizing costs, the instructions themselves offer this general practical advice. To limit interest and penalty charges, file your return on time and pay as much of the tax as possible with your return or notice.
Back to that core idea. Pay early. Pay as much as you can.
Exactly. This is the ultimate tax-saving insight related to tax debt. Reducing the principal balance early on fundamentally reduces the accumulating costs over time, regardless of whether you're setting up an installment agreement or not.
Wow, we've really taken a deep dive into Form 9465 today. We've gone from understanding what an installment agreement is and when it's the right tool to exploring smart alternatives and critical fee savings, breaking down the form piece by piece so you know exactly what to consider and where those strategic choices lie, and finally, understanding your rights and responsibilities throughout the entire process. Feels like we've truly demystified a really intimidating topic.
Indeed. The aha moment here isn't just about how to fill out a form. It's about realizing that even when facing tax debt, there are structured, manageable paths forward. It underscores the power of being informed and proactive in managing your financial obligations, and how that informed action can directly translate into minimizing the financial burden.
It really does. It transforms a potentially overwhelming situation into something navigable and manageable, and that's incredibly empowering. And that brings us to our provocative thought for today. In a world of increasing financial complexity, how does understanding these detailed, seemingly niche, bureaucratic processes like navigating an IRS installment agreement empower individuals not just with their taxes, but in navigating any complex system, transforming fear into actionable knowledge?
That's a great question to ponder. Knowing the rules of engagement, the actual mechanics of how things work with any large institution, whether it's the IRS or something else, it can truly shift your perspective and your outcomes. It turns what might seem like an insurmountable obstacle into a series of steps you can confidently take.
Absolutely. It's about turning that fear or confusion into a plan. Thank you for joining us on this deep dive. We hope this has given you a clear roadmap should you ever need to navigate an IRS installment agreement. Keep learning, keep asking questions, and we'll see you next time for another deep dive.